Ever looked at your paycheck in Canada and wondered where your money actually went? There's a popular saying in Canadian personal finance: taxes aren't the problem. Not understanding them is. New to Canada or just starting your career? Taxes can seem tricky, but some 2026 updates might actually save you some cash. The CRA has updated tax brackets and benefits for inflation, so knowing what matters can help you keep more of your hard-earned cash. Let's break it down in plain language. Here's what newcomers and early career Canadians should know about taxes in 2026. 1. How federal tax brackets work in 2026. In Canada, your income is taxed in steps, not all at once. In 2026, federal tax brackets are increasing slightly because of inflation. That means the income limits for each tax rate are a bit higher. 2026 federal tax brackets. Up to $58,523 taxed at 14%. Earning between $58,523 and $117,045, you'll pay a 20.5% tax. Income from $117,045 to $181,440 is taxed at 26%. 29% on income over $181,440, up to $258,482. 33% on the portion over $258,482. Higher rates apply only if your income goes above those levels. Why this matters if you're early in your career? Most entry-level and early career incomes fall mostly in the lowest bracket. Only the portion above a threshold is taxed at the higher rate. Small inflation adjustments help reduce the impact of rising living costs. Your province also charges tax, but this works the same way and is handled automatically when you file. 2. Understanding the basic personal amount (BPA) is super important. One of the most important credits for newcomers is the basic personal amount. This is income you can earn before paying federal tax. In 2026, the BPA is $16,452. If you earn under about $181,000, you can claim the full amount. This reduces your federal tax bill by about $2,300. Tip for newcomers: even if you worked only part of the year or arrived mid-year, you may still qualify for this credit. Wondering why some cash disappears from your paycheck? Let's break down what EI and CPP deductions really mean. Employment insurance (EI) helps if you lose your job or take parental leave. Employee rate in 2026, 1.63%. Max $1,123. Canada Pension Plan (CPP), your retirement fund. Rates 5.95% and contributions rise as you earn more. Good to know. These deductions are not lost money. They build eligibility for benefits later. Let's break down the rates for a $60,000 yearly income. Federal taxes drop to $6,200 from $7,100, saving you $900. CPP and EI deductions fall to $4,480, saving you $15 total savings, $915. Provincial taxes will still be taken from your income. 4. Benefits and savings accounts. You should know about Canada Child Benefit. If you have kids, expect a 2% increase in 2026 paid monthly, tax-free. Many newcomers qualify even in their first year. TFSA limit is sticking at $7,000 for 2026, while the RRSP limit is jumping up to $33,810. Check out the video in the description for more info. Early career tip. A TFSA is often a great first savings account because withdrawals are tax-free and flexible. 5. What to do before filing your tax returns. File your tax return every year, even if your income is low. Set up a CRA account as early as possible. Track rent, tuition, and moving expenses if applicable. Start small with TFSA or RRSP contributions. Ask questions. Canadian tax rules are learnable. If you're new to Canada or just starting your career, learning how the tax system works early can make a big difference over time. Follow for more simple, practical money tips for life in Canada and drop a comment with what you want explained next. You've got this.